Now, despite the events of last year, experts predict that this year will bring substantial returns for the U.S. economy. Time will tell. Cases are falling in the U.S., vaccine rollout is progressing, and the economy has received trillions in stimulus from the government. So how should you invest in the market for the post-COVID economy? Heck, is it too late even to buy? Let's just dive in. As the falling trend in hospitalizations and rising vaccinations enables economic reopening, we expect the recovery to broaden. Areas with the most catch-up potential are developed small and mid-sized companies and select stocks across the financials, energy, and industrial sector. In general, cyclical stocks are the next area of opportunity. Cyclical companies that make or sell discretionary items and services that are in demand when the economy is doing well. They include restaurants, hotel chains, airlines, furniture, high-end clothing retailers, and even automobile manufacturers. Think about the travel industry. It has a massive opportunity to bounce back. Those who've been stuck at home or have had limited activities for a year now will be able to release that pent-up desire to travel and socialize freely. And those airlines, hotels, and cruise stocks that have been down for so long, these will likely bounce back to pre-COVID levels, if not higher. The chance to get back to operations at full capacity in tourism brings good news for restaurant stocks who have already seen rallies following the vaccine rollout. Online vacation rental marketplaces are on the rise as well, especially as more and more people have wanted to feel more privacy and safety while traveling after the events of this last year. Airbnb's IPO success in December is proof of this. Stocks such as Expedia and Uber are also looking ahead to the future of travel and ride-sharing. At the same time, Expedia and Uber have steadily climbed upwards after the huge hit that they took last March. All of that leaves investors wondering which of our digital habits we'll stick with when life is back to normal. The market is already giving us a few hints. Already, stay-at-home stocks such as Zoom and Peloton have seen significant declines from peak prices, and that suggests that they may not be as much of a staple outside of the pandemic. However, consistent gains at companies such as Amazon and Shopify, Domino's Pizza, and even Netflix predict that we'll still be taking advantage of instant delivery, streaming, and even online shopping. Now, more investors have turned to ETFs to create a diverse portfolio and passively invest. Others have looked to more fixed income strategies in volatile times, such as bonds or even annuities. We think investors should look ahead at a cyclical recovery looking for catch-up potential. Now, what about timing the market? Yep, we warn against this a lot. So, while there is opportunity to catch up, you should pay more attention to the long-term picture. Given the choice between investing immediately or waiting for stocks to get cheaper, putting money to work for the long term is usually always the best choice. Give Trajan Wealth a call. Allow our advisors to help take your emotions out of your investing. Our fiduciary advisors will get to know your situation, create and balance your portfolio, and have annual reviews to ensure that you're staying on track. So, I'll see you next Monday. Take care.